Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/The Smattering, to get access to the 10 best stocks to buy right now. Teladoc Health just reported third quarter results this week, and there's some good things in the report, and there's also some things to be concerned. I'm Jason Hall. This is The Smattering, and if you're watching this video, you're probably trying to make heads or tail of that. We're about to dig into it right now. I'm joined by Jeff Santoro. Jeff, I'm going to go ahead and bring up the highlight slide from the company's presentation. We're going to talk through this real quick. All right, Jeff, let's take a look here at the financial highlights for the company. There's been a lot of bad news so far this year for Teladoc. The good news, though, is that revenue continues to grow. The adjusted loss is kind of falling in line. The outlook continues to be pretty strong for that mid-teens growth. Things aren't really maybe necessarily as bad as the market's made it out to be for the stock, Jeff. What do you think?
No, I agree. With so much of the pain we've seen in the stock this past year is partially just because of the market itself falling, but I think investors got a little bit ahead of themselves with the triple-digit growth we saw during 2020 and the high double-digit growth we saw in early 2021, where this company is probably going to be more mid-teens to 20, 30% growth moving forward. And that's kind of what we've seen the last couple quarters.
I'm going to take a look at a couple of other slides here, Jeff. Let's kind of get into the heart of the revenue, right? So again, we think about where it does business. You see on this slide, 17% growth in the U.S. and its international markets. But we can see on a dollar basis, the U.S. is obviously its most important market, but it is starting to make some headlines or some headway outside of the U.S. as well. Jeff, this is a slide that I want you to weigh in here, because that access fee revenue, we see that's up 20%. That's a positive, right? Because of where that number's being generated from.
Yeah. And, it's concerning that the visit fee revenue is only up 5%. And, that's been it's been higher in the past. In the last couple quarters, it's been low double digits, mid single digits. But I think, again, kind of like what you said on the last slide, it is also important to understand that access fee revenue is a larger portion of revenue. So it's not super concerning that the smaller part is growing slower, but you want to see that kind of pick up over time.
Jeff, here's the thing that I'm maybe, if you'd say, really concerned. This is the one that I guess you could probably say the thing that I'm paying the most attention to. Yes, we're seeing great growth in that access fee revenue. It continues to expand relationships with its healthcare partners. But if we look at the visits numbers, Jeff, this is something I'm really focused on. So I've owned Teladoc since probably 2018 or 2019. And back then, this obviously wasn't a COVID story because COVID wasn't a thing. And the idea is access to healthcare, driving healthcare costs down, things like areas that, if you live in Wyoming, West Virginia, other areas, you might be 6 or 8 hours away from a specialist, right? And you need to see a cardiologist. Having access to those kinds of care can be really challenging in a lot of places. So the idea is the tool that can help drive those costs down. But what we saw was when COVID happened, obviously companies like Teladoc immediately benefited substantially. There was even changes in regulation to make it easier for people to have access to using these telehealth tools. But then in 2021, visits were even higher. So we're a year into the pandemic. Doctors' offices were starting to open back up. It was easier to go in to see your doctor, but the telehealth visits continue to grow. Now, fast forward to now, and we're starting to see those visits and platform-enabled sessions are actually getting flat. And even in the case of sessions, as we can see, they're declining. How do you think about that?
Yeah, you'd want to see them be closer to each other. I mean, when you have the business growing in terms of revenue at a larger rate and even membership at a larger rate than some of the utilization and visit metrics, it does make you wonder, do more people have access to it but aren't taking advantage of it? And then if so, why?
Yeah, I think that's a fair way to think about it. Let's talk a little bit about the business's operations a little bit. We've talked about patient access. We've talked about membership. We've talked about those relationships with providers. And we know what's going on there that's driving the revenue, but this is going to give us a look at what's happening on the other side of business and the operating results. So you see on the chart on the right, adjusted EBITDA and adjusted EBITDA margins. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And then the adjusted part is there's some other things that they might attach to that as well, like stock-based compensation and other things. So it's important to know the details. And then EBITDA margin, right? So the percentage of EBITDA of that's the percentage of revenue, those numbers have come down. But we saw this quarter on a sequential basis starting to come back up a little bit. I think this is important because you look at those gross margins and adjusted gross margins, the revenue minus cost of goods sold, those numbers have continued to trend higher. So it does look like we might be coming through kind of the backside here of operating costs and getting a little bit better operating leverage, Jeff.
Yeah, I mean, the last 2 quarters were so bizarre to kind of take into consideration because they had 2 enormous goodwill impairments due to the Livongo acquisition from a couple of years ago. So, you know, their bottom line numbers were skewed like ridiculously last 2 quarters. But if you exclude them and just look, you know, a year ago or even before that, you know, those profitability metrics are not good yet, but they're all ticking back up. So to your point, you know, it is interesting. I really now I'm curious to see how the next quarter goes and the one after that, because I want to know if this is just a blip or if this is the beginning of a trend towards, you know, eventually getting to profitability.
Before we get into one more detail about some of the things that are going on with operations and with cash flows, which I think that's where the real positive is. You mentioned chronic care, you mentioned Livongo, right? And we know the company has taken massive amounts of we're talking billions of dollars in write-downs after that Livongo Health acquisition. And I think it's important to note that if we look at this number right here, unique chronic care members, right, which is largely members that carried over from Livongo Health for things like diabetes, right? They have other chronic illnesses that they use its tools to manage those illnesses with. We see that the member data there that has been steady and has even grown a little bit over the past few quarters. So that's a positive for the long term. The company's already kind of taken the hit, right? It's ripped off the Band-Aid and then it ripped the Band-Aid off again the next quarter. But there's still some real cash flow and real benefit from what's left of that Livongo merger or that acquisition.
Yeah, I mean, there's an argument to be made that, you know, they obviously paid way too much at the wrong time for Livongo, but there's an argument to be made that over the long term for this business, you know, 10, 20, 30 plus years, you know, that acquisition could end up being a really, really smart one. You know, and I don't have it in front of me right now, but if I'm remembering from previous earnings calls, you know, those chronic care patients are very valuable patients to the company in terms of like adding on new services and things like that. So, you know, that just widens the funnel that at the top to kind of bring in customers. So it's good to see that trending in the right direction.
Jeff, a couple of other points I want to make. I mentioned we talk a little bit about operations, the bottom line results, and on a GAAP basis, the operating loss has grown. Was a higher loss, but if there's one thing you can put your finger on that operating statement that's much larger, that's driving that larger loss, it's advertising and marketing. What are your thoughts on that?
Yeah, I mean, I think the advertising and marketing spend is something you're going to have to kind of just deal with. And I could make the argument that you're seeing some positive results from that spend, right? So some of the positive numbers we've seen in terms of, you know, memberships growing and things like that, you know, you could make the argument that that's because of that increased spend. On the flip side, if the utilization rates are lower than they need to be, you know, then I would wonder maybe if some of that marketing and sales and marketing spend needs to go towards that aspect of getting the customers engaged once they have access to the platform.
Yeah, that's a good point. And kind of the way I think about it right now is this is a highly competitive industry. There's a lot of big companies, a lot of tech companies like Microsoft, for example, that's, you know, playing in the same space. This is a land grab. If there is a time right now to dedicate resources to sales and marketing, this is absolutely it, Jeff. And I think that's particularly the case when you peel the layers back a little bit more and you start looking at cash flows, and the company's cash flows, operating cash flows, actually are positive and they continue to grow. The company generated something like $125 million in positive operating cash in the first 3 quarters of the year, right? So it's in pretty good shape. Also, the balance sheet is strong. As much as we've seen those write-downs and it's taken a hit to goodwill for impairing the Livongo Health, it has over $1 billion in cash and very manageable liabilities at this point, right?
Yeah. And then, just if you just take a step back after thinking through all that, telehealth is not going away. Like, yeah. I don't imagine a world where 10, 15 years from now, we're doing less of it than we are now. So the fact that they are, making progress in, like you said, in the land grab part of this, of the cycle here and just trying to get as many members as they can, they're still the largest telehealth provider by a good margin, if I remember correctly. So they're in a position to kind of keep leading as this industry is almost certainly going to keep expanding over time.
Hey, Jeff, after looking at the quarterly results, thinking about everything that's happened for the company over the past couple of years, I think my take right now is for an investor that's looking to start a position that has the intestinal fortitude and the time horizon to own this business for 3 or 5+ years, I think it's really interesting right now to start a position and start building out a position. It's not one that I would want to own a lot of right now because there is a lot of uncertainty. We talked about that sales and marketing expense, how highly competitive it is, but there's a lot of opportunity. And to me, I think this is a chance. I think this is a good time to think about building out a position if you're an investor and get started. I'm going to give you the last word, Jeff. What do you think?
I agree. If you are bullish on the industry, if you think Teladoc's position in the industry is going to keep it in the lead for the foreseeable future, now's, the stock's been beat down. Now's a good time to do it. I even was able to find some bright spots in the last 2 quarters where they did have that big goodwill impairment and the stock sold off, 20, 30% each time. There were still glimmers of hope. Things were heading in the right direction in some aspects of the business. So they've never really hit a point where all hope has been lost. But I think you said it right. You have to have the intestinal fortitude to live through maybe still a couple years of subpar or choppy results. But there's a case to be made that over the very long term, this is going to be a business that rewards shareholders.